So that reach for yield theme has been very dominant across all markets and in fixed income since the financial crisis in 2008. Looking at fixed income, I mean, fixed income is a very broad and diverse asset class. Within that, credit really has been the go-to choice in terms of reaching for yield. Credit itself is also very broad and diverse, has a number of subsectors, and the way that reach for yield has manifested in each of those is quite different. So just generalizing here, our view is that the most easily accessible parts of the credit market have been the ones where that reach for yield flow has been strongest and had the most effect on pricing. So that would be things like investment grade corporate bonds, high yield, emerging market debt, some parts of the loan market. And that's really the segment of the market where we see things potentially changing. What we see in that space is that the returns that you're getting, the credit spreads, are very close to historic lows. But importantly, this is happening at the same time where we're seeing that the reach for yield dynamics have created the biggest distortions in pricing, and also that the risks associated with those parts of the market are increasing. So we see that in terms of late cycle behaviours, so things like companies increasing leverage, borrowing money to fund share buybacks. We're seeing creditor protections in bond and loan documentation getting weaker and weaker, and some pretty extreme reach for yield behaviour. So for example, last year there was a European utility company, BBB rated, that was able to issue a 3-year bond at a negative yield. So it's hard enough to justify government debt trading at negative yields when you have a BBB company which is not far off from being high yield, basically getting paid by investors to borrow money. That's pretty hard to understand. So we sort of see that as, you know, the kind of behaviour you might see towards the end of a big night out, where it seems like a good idea at the time, but the next morning not so much. So we're pretty cautious there. The question is what turns things around. The obvious catalyst would be a turn in the credit cycle. So say a recession leading to higher defaults and money flowing out of credit. We don't really see that happening at the moment. What we see is another catalyst, which is less obvious, but equally important, if not more important, which is simply that the conditions that triggered the reach for yield behaviour in the first place, which was low rates, particularly in the US, we're starting to see that now reverse. And if you look at the largest credit market, which is the US investment grade credit market, so far this year, credit spreads in that space have been among the worst performers across global financial assets, which you wouldn't expect when you have growth strong, unemployment low, default rates low. So why is it happening? It's because government bond yields are going up. And for the first time in a long time, you've got things like 3-month T-bills in the US giving you 2%. And so a lot of that reach for yield money that had come into credit, the credit tourists essentially, are now going back out of credit. And we think that could end up being quite disruptive to credit markets.